Good evening, everyone. I'm CA Akanksha Gupta, the moderator of this webinar. We are delighted to welcome you all in the webinar being organized by the Continuing Professional Education Committee of ICAI. It is my pleasure to be the moderator of the webinar on opportunities in derivative and startup valuation. In a short while, we will start this webinar. First, I would like to apprise you about the CPE Committee. In today's ever changing professional scenario worldwide, the biggest challenge the professionals face is how to stay on the top of the game while adapting to new requirements and norms. Therefore, it is imperative to aim to be up to date and to offer unique guidance and influence others with the innovative approach and expertise. It is also vital to stretch old ideas beyond traditional boundaries to create new perspectives. In this context, continued professional education facilitates professionals to maintain, improve, and broaden their knowledge, skills, and expertise required to achieve professional goals through webinars, seminars, etc. The program for this evening is as follows. We will have two sessions of 1 hour each, and the topics are opportunities in derivatives and options, and startup valuation. Our eminent speakers will talk about the above mentioned two emerging areas of professional interest. Before commencing the webinar today, I would like to read out the biodata of Chairman Sir Shri C.A. Purushottam Khandelwal Sir. He is the chairman of CPEC and convener of RPA Directorate of ICAI. He is having 25 years post-qualification experience in the field of audit, direct and indirect taxes, and intellectual property rights. This year, he is devoted to fortifying CPE framework and guaranteeing quality across entire operational spectrum. And this year, major focus would be on upgrading the CPE portal for enhancement of the branding and professional competency of the members. Now I request CA Purushottam sir to deliver a welcome address to our esteemed audience. Over to you, sir.
Good evening, respected immediate or a past chairman of the Rajkot branch of Gujarat, Hardik Bhai Vyas, moderator Akanksha ji from Satna MP, Nirmala ji, second faculty, secretary of the CPEC, Ajit Naji Tiwari, office of the CPE committee, respected member. It gives immense pleasure to be amongst you on this Wednesday evening. Every Wednesday day is dedicated to members, and my committee is organizing a webinar for the member of the professional interest. CPE committee is the mother of all the committee. My committee is continuously organizing a conference, half-day seminar, full-day seminar, webinars, residential refresher course, workshop for the updation of knowledge of the members. I would like to say that every members, those who are in practice or in industries, must have a reading habit, because what we are going to deliver today may be outdated. Learning, de-learning, and relearning is my welcome to the vice chairman of the CPE committee, J.C. Mishra ji, to this webinar.
Thank you, Chairman sir.
Sir, I will 2 minutes में खत्म करता हूँ sir. So, member has to de-learn and relearn. जो आज पढ़ा है वो कल पुराना हो सकता है. Companies Act 1956 is now outdated. Now new company law in force. Income tax every year there is a changes. So we must have a reading habit. What we are selling? We are selling our services. We are selling our time. So we have to price tag of time. If the advice given to client may be perfect, relevant, and current. So CPE committee is doing dedicated efforts to organize this webinar and seminar for the members at every Wednesday. This year, we are planned to come out with a dashboard. Ajit ji and we everybody know that the one dashboard will be there. We will register all program of 175 branches in the same portal, and you can choose your professional interest topic and attend the programs. You have to pay money from the single window and will send to the respective branches. We are also looking for the CP chapter and circle. We have a jurisdiction of the CP chapter and circle. They are also arms of the ICAI. They are also doing a wonderful program in their local area where there is no branch or there is a regional council. So we all this year we are organizing one All India Management Week where we invited the branch managing committee and also we invited the deputy convener and convener of the CP study circle. So I will not take much of time because the topic which is selected is the derivatives. So you earn the money which the Hardik Bhai suggests you and invest in the startup which will be suggested by Nirmala ji. So I welcome both the faculty. One, give you the source of earning, another, how to invest. So welcome to this webinar. I will not take much of time. Gyan Mishra sir is here. They will address you. Akanksha ji, over to you.
So thank you very much, Chairman sir, CA Purushottam Khandelwal ji, two very learned speaker, Hardik Vyas ji and Nirmala Soni ji, moderator, very young Akanksha, and of course the secretary of the committee, Ajit Nath Tiwari ji, and the entire team. Good evening to one and all. Friends, it's indeed a great pleasure and privilege to interact with you all in this very, wonderful webinar which has been organized on every Wednesday, 4 to 6. So at the outset, I'm very much thankful to the leader of this committee, CA Purushottam Bhai Khandelwal, who has done so many
leader, sir.
so many activities for the committee this year. And of course, so many reforms are underway. I hope that Purushottam Bhai must have, briefed about the technological development and few of the reforms with respect to the committee that has been undertaken this year. Friends, both the sessions are really very important. One derivative which is going to be one of the core area of, I will not say practice, but certainly of earnings for the members at large across the country. Chartered accountants are so much involved in the stock market, and that's how we are seeing that the Sensex and Nifty are touching a lifetime high on day-to-day basis. And Hardik Bhai will be briefing about how to play in the derivatives and what could be the major things that we have to keep in our mind. The other speaker, Nirmala Madam, shall be taking valuation of the startup. So that is also a very important topic because nowadays we can see that so many small and medium companies are coming in the IPO through the main board. So startup, to understand the startup of the valuation of the startup and how to invest in that and how to come with the actual price of those startups. That is to be explained by Nirmala Bhai. Friends, I'm sure that these weekly webinars are knowledge enriching to all of us, and this is the time when we have to learn, we have to upgrade ourselves. One very important thing that is taking the entire gamut of the technology in itself, that is artificial intelligence. So Institute has come up with Artificial Intelligence Committee also. So many programs are organized. 2 days back only, we had, yesterday itself, we had this program of National Conference in Hyderabad. So areas for practice for the chartered accountants is too high in coming time. So it is on us how we are utilizing the time and how we are focusing for the newer applications. I'm sure that with the change of technology, with the newer avenues, and with the thoughts and intelligence that the profession has carried for last 75 years. We shall keep on providing the best of the services to the society at large. And most importantly, the brand CA will keep on flourishing in coming time. Thank you, Chairman sir, for giving the opportunity. And the last thing that I would like to request all the participants that if any one of you is desirous to be a speaker, moderator, writer, or any type of support or any type of suggestion for the committee, please do write to us. And CPE committee is your own committee, because anything starts from CPE. So we are dedicated to provide best of the services from the committee. And I wish all the best for the happy learning to each one of you. We shall be meeting on next Wednesday again. Thank you very much.
Of the members, we can directly proceed with the second session. Our second speaker, CA Nirmala Soni ma'am, has over 10 years of experience in auditing, taxation, costing, payroll, budgeting, export and import, etc., and specializes in project financing, auditing, and startup mentorship. She is also registered with Insolvency and Bankruptcy IBBI for asset class, securities, and financial assets. Over to you, ma'am, for your session.
Thanks, Akansha. Thanks to the good evening. Thanks to the ICAI CPE Committee, Chairman Sir, Purushottam Sir, and Vice Chairman Gyan Sir for giving me this opportunity to share my views on this platform. And the co-speaker, Hardik Sir, has shared a very good topic, derivatives. So it was very knowledgeable session. So my today's presentation would be on startup valuation. So before starting, I would like to share some things that startup is an emerging field for the chartered accountants. They can directly contribute to the ecosystem by giving their services to the startups to scale up their business from the initial stage, or they can directly contribute to the ecosystem by having their own startups. There are many CAs who have started their own startups. Like if we take the example like CA Namita Thapar, CA Aman Gupta, they are the successful entrepreneurs. Since the CAs know in and outs of all the business, they can run the business very well. The Namita Thapar has a good startup like Anchor, and Aman Gupta has a good startup like a board. So it is very emerging field. So chartered accountants should divert their scope of work from auditing and taxation to this startup area also. Let me share my presentation. Hello, Akansha. Whether presentation is visible?
Yes, ma'am, your screen is visible.
Okay, just. Okay, so our today's topic is startup valuation. So in this topic, we would be covering various topics like who can be the registrar valuer. Since startup valuation is done by the registrar valuers, so who can be the registrar valuer? What is the asset class? What is valuation? Which approaches to be applied for the valuation of startups? What is startup? Life cycle of the stage of the startups. Funding options for the startup. Why startup fails? Startup valuation method with the examples. So all this topic would be covered one by one. So who can be the registrar valuer? So registrar valuer is a member of IBBI as a valuer. So previously there was the valuation was done by anybody. The valuation was not proper. It was a window dressing. Since means if the valuation of the business is 100 and it is showing up 50 crores, so there was a window dressing. So to streamline the process of this valuation, the Companies Act amended in 2017 and come with this regulation section 247 in the Companies Act, and it deals with the company's register valuer and valuation rules 2017. So this regulate all the valuation work. It regulates the register valuer and all the process of the valuation, what are the valuation standards, which are valuation approaches to be applied for the valuation purpose. It is a regulatory authority for the like regulatory authority would be IBPI, and all the regulations would be done by them. So valuation can be done in respect of any property, shares, debentures, any business, goodwill, or any other assets which is having the worth of a company or its liabilities. So valuation is done by the registrar valuer, who is a member of RVO. So RVO stands for the Register Valuer Organization. So RVO is the mediatory. We are registered with the RVO, and RVO is the main body registered with the IBPI. So there are 16 RVOs as present, and ICAI RVO is one of them, which deals with the various asset class. So typically there are two types of assets class, like technical as well as financial. So in technical, it would be a land and building, plant and machinery, and financials, it would be SFA, securities and financial assets. So the technical part is taken care by the civil engineers, mechanical engineers, or electrical engineers. But the financial part, SFA, is taken care by the CAs, CMS, CAs, MBAs. So all the financial businesses valuations are done by these professionals. So this was about the registrar value, who can be the registrar value. So then what is the valuation? What do you mean by the term valuation? So valuation is related to a specific point of time. So what is value? Suppose any business is valued 10 lakh rupees right now. So after 1 year, it would be at 12 lakh or less than 10 lakh. So it is specifically to a point. Specific to a point of time. So what is being valued? Whether shares are valued, business is valued. So purpose is very important in the valuation. What is valued and why it is valued. Whether business is valued for the funding purpose, or whether business is valued for the merger or acquisition. So what is valued and why is valued is very important. Whether shares are valued for the IPO purpose, whether shares are valued for the right issue, buyback issue. So it is very important what is valued and why is valued. Purpose is very important. Whether we are valuing business as a going concern, whether it is for the expansion purpose, or whether it is for the liquidation purpose, like a merger or acquisition, or any company which is going into insolvency, like a Byju's. Recent example can be a Byju's. Or for the merger or acquisition, the business is valued for the merger or acquisitions. So basically, there are three approaches for the valuation: cost approach, income approach, and market approach for the valuation. So any asset which is having a worth is can be done valuation. Like valuation is a process of appraisal or determination of value of a tangible assets, or of an asset which can be a tangible asset or intangible asset, like goodwill, royalty, securities, liabilities, or specific businesses as a going concern. So as Professor Damodaran said, the valuation discipline is neither a science nor an art. It is a craft that one learns by doing it. So once and more assignments one do, the better they can do the valuation work properly. So basically, there are two types of valuation: absolute valuation and relative valuation. So absolute valuation means when we do the valuation based on our company's own data, like financial statements, audited financial statement, projections of the companies, management decisions, management strategies, that it is called as absolute valuation. And relative valuation means when the valuation is done by taking other companies as an example, like a PV multiple of other companies, EV beta of our companies as a multiple, and we do the valuation. It is called as a relative valuation. So basically, in case of absolute valuation, cost approach as well as income approach is the absolute valuation, and if we do the valuation as per the market approach, it is a relative valuation. So basically, three approaches for the valuation: market approach, income, and cost approach. So all these three approaches are based on the economic principles of price equilibrium, anticipation of benefit, and substitution. So basically, in these three approaches, there are various methods or techniques for the valuation. Like if we go for the cost approach, it can be it has the net asset value or liquidation value. Or if we go for the income approach, it is DCF method, relief from royalty method, excess earning method, incremental cash flow methods. If we go for the market approach, it can be a market price method, comparable companies multiple method, comparable transactions. So it is not we can go for only one approach. It is up to ourselves. If we find that the income approach, the projections received from the management is not up to date, we can have other approach also. We can go for the market approach or cost approach. So based on our judgment or based on the facts and figures given by the management, we can decide that whether we should go for one approach or two or combination of approach, or same we can give the uh, weightage to the each approaches. Like we gave 80% approach percent to the income approach, 20% to the market approach, and based on this we can get the valuation of the business. So this was about the valuation, and who can be the register valuer, who is the RVO. So our today's topic is startup valuation. So we should understand the term startup. What do you mean by the term startup? So startup is like any business which has the innovation and creativity. So it should be very new or unique creation. Like earlier there was one-to-one selling was there. Means I was a seller, and if any buyer comes to me, I would sell my stationery or ready-made garments to them. But now the thing is that the platform is created, like a Zomato, Naukri.com. The platform is created. So there are n number of buyers, n number of sellers are listed on that platform. So instead of only pipeline selling, there is a platform selling, means pan India selling is there. So to create new things, innovative things, there should be a proper channel. Means we have to register, like if we come the food delivery app, then the various restaurants should be linked to that. The proper marketing should be there. So innovative ideas should be there. Scalability, the business should be such that it should have a scalability. Means it should not be restricted to one state or one region or one city. It should be of pan India basis, or it can go to international level, or it could have a multiple regional offices, or like a Zomato, it is having a presence all over India as well as international, so that it can give the maximum number of jobs to the delivery boys. Risk taking, since it is an innovative idea, it is having much risk associated with it. So the co-founders is at a much risk while starting a startup. So startup basically it is formed to solve the real life problems, to have the solution for that real life solution. They can have it is as per the society needs. So then only it can have the investors, funders, so that if there is a growth, then only the investor can invest in such type of a business. Like there are waste management startups, so they are solving the this problem of a waste. So the waste are utilized for the good products, like plastics. From plastics, they are making t-shirts, they are making shoes, they are making any bags. So the waste product are utilized for the good product. So in a startup, the 3 P's are very important: people, product, and process. So people means the founder, co-founder, their skills, expertise are very important. And the audience, the market is very important. The target audience, the product is made for which generic miss market. Like if a baby product like Mama Earth, so they are making the products which is good for the babies. So target audience is set that babies, for the newborn babies, the products are there. Product is very important. They should be liked by the customers. The product should gain the confidence of the customers. And the process, the whole process, in case of a startup, the process should be streamlined. Suppose anything was having time is to taken was 3-4 days. Now it should be streamlined, that it should be made within 3 to 4 hours. So the process should be streamlined. So there is no definition of the startup like if we deal with the Companies Act, there is a definition of the companies. If we deal with the Partnership Act, there is a definition of a partnership firm. What is a partnership firm? But for the startup, there is no act as such. So there is no definition of the startup as such given in anywhere. But only one definition is there in the startup, which is given by the Ministry of Commerce and Industry, Department of Industrial Policy and Promotion, DIPP, which is now termed as a Department of for Promotion of Industry and Internal Trade, DPIIT. So what definition they have given? The entity shall be considered as a startup if it is having its existence less than 10 years. So up to 10 years from the incorporation, then it can be considered as startup. Like a Zomato, it is running from the 13 to 14 years. So it is would not be having the benefit of a startup right now, because it is beyond 10 years. Private company, it should be a private company or partnership or LLP. So proprietorship cannot be a startup. It should be private company, partnership firm or LLP. Turnover should be less than 100 crores in a year. Working towards innovation, development or improvement of product and process of services. It should have a scalable business model, like high potential of employment generation and wealth creation. So high employment generation. So basically, benefits are given for the startups. Tax holiday benefits are given. So same definition has been used by the tax department also. Tax department using the same definition of startups for tax breaks. Even the SEBI has adopted the same definition under AIF, Alternate Investment Funds Regulation Income. Of same definition is used by all the three ministry, all the three departments. So once the startup gets the DPIIT registration, means they are recognized startup. Means like a company gets the certificate of incorporation, they can have their existence, means they can start a company. So in case of a startup, there is a startup regulation is done by the DPIIT registration. So what is the ecosystem of the startup? So to develop this startup, there should be a proper ecosystem which can help the startups from the initial stage to scale up. So there are various persons in the various types of organization in the ecosystems, like incubation centers. So incubation centers means the centers which provide the benefit to the startups. Like startups, the founder, the co-founder have only idea, but they don't have the funds for the starting of the business. They don't have the space, or they don't have the furniture, laptop. So this incubation centers provide them space, provide them the required infrastructure like a laptop, furniture, Wi-Fi, everything is provided to them, so that they can concentrate on their idea, so that their idea can be implemented in the best possible way. So in incubation centers, few incubation centers don't charge anything if they are new, but some charge very nominal fees, so that all the new startups can register with these incubation centers and get the proper channel. In these incubation centers, there are various mentors or registers, like financial mentors, legal mentors. If there are, since if any founder or co-founder is they are making an app, but they are not good at the finance part. They are not good at the marketing part. How to market this product, how to do means all the proper documentations. So these mentors help them to guide proper, so that these mentors help them to means properly document all those documents from initial stage, how to market the product, how to target the audience, means they give the ideas to them. Banks, government, interact, all these form a good ecosystems, so that the startup can work very well. Like there can be big companies, universities, funding organizations, service provider, research organization, support organizations. All these are the part of the ecosystem. So basically, there are three stage in the startups. Like if they're very early stage, only idea is there, or MPV means minimum viable product. A small means only product is launched, product is made. Then there is a growth stage, means at least a working of startup for 2 to 3 years. More than that, means the product is liked by the customers. They have gained the confidence of the customers, and their product is having the means international as well as international presence. They are earning good, like Zomato. Then they after that they can go for the IPO also. Mature startups can go for the IPO, like Mama Earth and Zomato has gone for the IPO. So in early stage startups, they can be valued as per the asset-based, cost-based approach. Since there are many very less cash flow in the initial stage, there is no guarantee that the company will be able to operate as a going concern. So in the initial stage, if we want to value the startup, then it can be by the cost approach. Suppose any software is made for and the cost for that making the software is 5 to 10 lakhs, then the valuation would be done by this figures. Or we can use for market approach. Like if we do any startup is there, like which is very much like Zomato. So Zomato valuation is this. So if the Zomato was in this initial stage, what was their valuation? So we can go for the market approach. We can use the multiples, P multiples or market multiples. In case of a growth stage, since the market is very much liked by the customers, product is market fit. So we are getting good revenue, or then we can give means have the proper projections of the revenue. So we can go for the income approach. And in case of a mature startup, we can go for the market approach, because we can use this approach. Like our products can be listed, our products can be go for the IPO. So if the startup is going for the IPO at a price band of this, and our startup is in the same field, like EV field, then what will be the price band of our startup? So we can go for the market approach. So mostly, these are the 7 reasons why startup fails. So mostly the startup fails because of insufficient money, 37%. So if they don't get the funds at the proper stage, their survival gets stuck. So majorly there would be means proper flow of money. There would be means investors ready to invest in such type of startup. The product should be properly. Then the other reason would be the poor management. The founder, the co-founder, since in the startup, the founder, the management, and the shareholder are the one and the same. Since it is a small business, so the shareholder and the management is the same. So the whatever the skill and the whatever the experience of the shareholder, they only manage the business. If they are not proper, they don't have the proper skill, the startup will fail. Then there lack of consumer demand. The next would be the lack of consumer demand. If the product you have made, it is not liked by the customer, it is not solving the any society needs, then obviously the startup will fail. Then the other reasons are pricing model, poor marketing. If marketing is not done properly, customer satisfaction, legal issues. Like legal issues, the recent example would be Byju's. So since the Byju's don't have made their proper financial statements on time, they are not able to predict that their marketing expenses were very high. And the auditor of the company has resigned. Because of all this, the share means the investors have resigned from this startup. The investors have pulled their money back from these startups. So the Byju's was having the valuation of 22 billion before 22 dollar billion before. Now not having any valuation, they are going into insolvency, and they have to make the payment of there are the NCLT have made the penalty of 159 crore to them. So legal issues are created if the proper documentations are not done, proper financials audits are not done on time, or everything is not done on time, the startup will fail. So in case of a valuation of a startup, the company goes into various stages, means how the funding should be there. So to understand the funding of the startups, since funding is very important for the growth, expanding the operations, achieving the strategic objective. So the funding of the startups can be in a three form. It can be an equity form, debt form, or alternative funding resources. So if they go for the equity, means any angel investor or venture capitalist invest in a startup, they have to give their share to the investors. So, but in this case, only dilution of ownership is there. Don't have to obligation of repayment. But in case of debt financing, if they go for debt financing so from the lenders or financial, then there is a promise of repayments of interest payments as well as principal payments on time. Otherwise, if they delay or if they default, their goodwill will be affected. Alternative funding resources such as crowdfunding, escalators, grants. Startups get the grants from the, if there is a very unique idea, very innovative idea is there, then they get the grants from the central government, which is up to 20 lakhs rupees, and even they get the funds from the incubation centers. So it depends upon which type of startup is there, what are their growth potentials, they get the funds. So for getting the funds from the investors, there should be proper documentation, proper fundraising documentation should be prepared, like business plan should be there, like business plan which properly show market opportunities of the startup, competitive advantage. Since if it is a new in the market, no competitors are there at that time, so it is getting the advantage of being the first. Projections to attract the investors. So proper business development plan should be there. Financial modeling means proper projections of the financial projections should be there. Startup growth potential, what will be the revenue in the future, what will be the capital requirement. Suppose if we are working in a one city right now and we want to have the franchisee in 2 to 3 cities, what would be the extra capital required, what will be the resources we would be requiring. So proper planning of everything, financial modeling. Pitch deck creation, like if we go for the any interview, we have the resume, CV. So in case of a startup, pitch deck creation, pitch deck is a document which says everything about the startup. Who are the founders, who are the co-founders, when the startup started, what are the business module, who are the competitors, everything about the business of the startup is shown in the pitch deck. So when to value of startup, there are basically the startup are classified into pre-revenue stage as well as post-revenue stage. So basically, as we have seen the Shark Tank. So first question in the Shark Tank, they asked whether this startup is a bootstrap or you have raised any funding. Or if you raised any funding, how much shares you have diluted, ownership you have diluted. So what do you mean by the bootstrap? So bootstrap is a term used when the startup is funded by its own fund or funded by the any personal any savings from the family, friends, then it is called as bootstrap, means using the own resources, whether it would be a personal saving, personal computing equipment, garage space to start and grow a company, then it is called as a bootstrap. After bootstrap, then they are funded by the angel investors and venture capitalists. Angel investors, as the name suggests, angels, they are really the angels. Means they are investing in the startups in the very initial stage when there is no projection of the startup, whether the startup will work properly, whether the startup will go down. So will taking a much risk at that time, they invest in such business. So angel investors. And then there are venture capitalist firm, means bigger firms, investment firms are there, they invest in the startups, and mature startups can go for the IPO. So if they go for bootstrapping, means there are various options for investments. Like if they go for the bootstrapping, then the personal savings and revenues are used for the startups. Then what are the pros and cons? If they go for own funding, then full control of the ownership and the business, no debt or equity dilution. So effective use of resources means whatever decisions to be taken are taken to be quickly because no other management is there. Cons means limited source. Suppose I am having only 10 lakh rupees and other, but I want to expand the business, but I cannot expand the business without having any much funds. Slower growth potential, higher personal risk. Since whatever I have a personal saving, I have invested in the business. Then if I go for the angel investors, who are very good, means wealthy individuals, high net worth, NE, high HIN, high investment value investors, which give their investments in the business for the equity. So, like in Shark Tank, they use their own funds to invest in the startups, but they ask for the equity, 3%, 4, 5% based on the valuation. Then, if you use that investor funding, what will be the pros? Means access to sufficient funds, we get the funds on time, mentorship and industry connections like Amcure. So if any startup is of a pharma and they get merged with means Namita is ready to invest in that pharma industry, a pharma startup, then obviously they get the connection of other the means distributor of the pharma which are listed on a Amcure platform. Flexible investment terms, but there are cons. Means equity dilutions, means we have to dilute the equity. Loss of control means we have to means do the business as per the management with all the boards. High expectations, they create the pressures also sometimes because they have means they are invested so much funds in the business, so we have to do the decision based on them. Venture capitalist investment firms which have the high potential, have growth, they also invest in the startups for the exchange of equity. Then we get the large amount of capital, expertise, and mentorship from the experienced investors. Credibility and validation means our credibility increases since we get the orders. We complete our orders on time because of the funds. If we are not able to do our orders on times, then when the venture capitalists invest in the business, there is a dilution of the funds, sufficient dilution of the business, like utility dilution, high expectations, and pressure for the rapid growth, potential loss. Then, if you go for the crowdfunding, means crowdfunding means a small amount is collected from a large number of people. Suppose 100 rupees is collected from a 1 lakh person, then it is called as a crowdfunding. So access to large pool of potential investors can serve as marketing tool. Means we can give the means reward based crowdfunding. If we means any app, if you refer any this app to any person, then you will get the cashback of rupees 100 rupees, such that promotional can be there. So in this case there would be no dilution, but all this process take time, so it would be a time consuming process, requires a strong marketing campaign. Means there should be strong idea, so that only then one person can refer to another person, then another person can refer to another person. So it is, so proper marketing should be there. Risk of not reaching the funding goal. Suppose we have assumed that 10 lakh rupees is to be collected, but there can be chances that we collect only 5 lakh fund potentially. So we cannot get the things on time. if we go for the bank loans, if startups goes for the bank loans, so if startup go for the banks or loans from any financial institutions, then there is obviously there is no dilution of equity, but a fixed repayment of schedule is there. Means we have to pay the interest as well as principal payments on time. Interest payments can get on a, is a tax deductible as expenditure, so we can get benefit of this interest payments. But we for these loans, we have to give our collateral security. We have should have the good credit history, then only the banks will give the loans. So if any default is made on then our means image will be lost. Our startup will typically fall down because of that. If we go for the grants and competition, so and if compliance is good, so, if they every month, you have to report this. You, and the
There is some network issue at Nirmala ma'am's end. Nirmala ma'am, kindly check it. Technical team, please ask Nirmala ma'am to rejoin. I request the members to kindly be patient. Nirmala ma'am will be joining us shortly. There is some network issue at her end.
Sorry, it got disconnected. So the main topic, startup companies valuation, how to do the valuation. So in case of valuation, since the startup is, and suppose the startup is a very new, so limited history. So if we are valuing the startup, so we should be very careful because there would be no history of that startup. Financial challenges to raise the capital. So in initial stage, the funding would be very less. The more focus would be on the R&D part, no revenues. So focus would be on intangibles. So success ratio of startups are very less. They are means if they survive for at least 3 years, there are much chances of their survival. Success depend on management expertise. So mostly the success of startup depends upon the management expertise. Zomato recently brought a former Make My Trip as a CEO. So expertise is very much, management expertise is very important, or demand constant innovations. So model scalability is very important in case of a startup. So if the startup would, they should be constant renovate their ideas, introduce new product, new schemes, free gift, free cashbacks or something. Innovative should be there every time. So in case of startup valuations, a lot of guesswork is there. So as a register value, there can be different value. If I do a valuation of a startup, I've done the valuation as a 50 rupees per share, but another valuer who is taken the another assumptions, and as per him, the valuation is 55 rupees per share. So it depends upon the assumptions. Lack of historical data, forecasts are uncertain. So even we go for the valuation, means of projections. So for in case of a startup, the forecasts are very uncertain. So it is a valuation is a complicated mix of science and art. There are multiple methods. Means I do the valuation as per the DCF method. If another registered valuer is appointed, then he can do the valuation as per the venture capitalist method. So it depends upon the valuer to value. So these are the 9 methods for the valuations. So book value method, cost to duplicate method, DCF method, first Chicago method, venture capitalist method, market multiple method, workers scorecard valuation method, risk factor simulation method. These are the 9 methods based on which we can do the valuation. So book value, as the name suggests, book value. So there is nothing much in that. It is basically whatever the assets as on the balance sheet we are having on the balance sheet date, valuation date. We take the value of that assets less any if any loans are there or any debts are there, we deduct that debts, and whatever left is the valuation of the business, book value method. So but this method does not consider the growth or revenue. So we in normal practice we don't do the valuation as per this method. Cost to duplicate method means, as the name suggests, a cost to duplicate means if I want to duplicate any startup, what would be the cost? Suppose suppose Zomato is a food delivery app, a food delivery startup. If I want to make another startup as same as a food means Zomato means like Swiggy. So if a Zomato is having the cost of rupees suppose 10 crores, so another startup is made, then it would have a similar costing like it would be a 10 crores or a 9 crore or 11 crore nearby that. So in practice also, we don't do the valuation as per this method, because this method also does not project the future of potentials of the startup, generating revenues. What would be the revenues in the future, profits or return on the investment? What would be the return? Suppose any investor is invested in the startup, what return they would be getting in future, or does not capture the any intangibles like brand value. So this we do not consider. Then comes the DCF method. So in practice, we follow DCF method for doing the valuation. Means basically, the DCF method is followed much for the valuation. So in DCF method, what we do, we discount the future cash flows at the required rate of investment. And prosectly, the discounting rate would be higher. Since in the startup, the risk is high. So we take the higher discounting rate and the discounting would be done. So in case of a DCF model, first we should understand the business. What is the business? What is the business model? Whether it is into EV, whether it is into solar. So we should understand the business. Gather historical cash flows. What are the previous cash flows were there? Means they are having proper EBITDA or future is negative EBITDA was there, or so audited financial statements should be there. Then we should have the projected financial cash flows. Normally, we take the projections from the management. It should be around 5 years projections we take from the management for the cash flows, and we discount this cash flows to get the valuation. We calculate the terminal value of the business. Terminal value is the value. Suppose terminal value is the value of the business. If we sold the business in the near future, what will be the value of the business? And the same business would be have foreseeable future. So we calculate, means we are not into going into liquidation or anything. So foreseeable future would be have startup with having foreseeable future. So we are calculating terminal value and discount the cash flows. So this is the example. Suppose we get the projections from the management like EBIT, we deduct taxes from that, then we get net profit after tax. We deduct any investments made, means any capital expenditure is there. Then we add back the depreciation. Since depreciation non-cash flow or non-cash items, we add back the depreciation. Any investments in working capital, we have to deduct in this working capital. Then we get the free cash flow available to the firm, FCFF. Then we, in case of, if we get a FCFF, we should discount by weighted average cost of capital. If the capital structure of the company or startup having the debt element, then we can go for the weighted average cost of capital. Otherwise, we have to calculate by cost of equity. We have to discount by cost of equity, and we have to calculate free cash flow available to the equity shareholders, not firm. If there are no debts, if there are debt, then there is a weighted average cost of capital. Then we discount this weighted average cost of capital based on the discounting factor. Then we get the enterprise value, total value of the business. So how we get the weighted average cost of capital? So we first have to calculate the cost of equity. So cost of equity is calculated by CPM model. So CPM means a capital asset pricing model, CAPM. So we have to calculate cost of retained earnings. So we take treasury bill rates. So 10 years treasury bill rates plus beta of the sector. Like if you are valuing any IT sector company, then we go at least take 5 to 6 IT companies. Then we take average beta, or beta we can get from the Damodaran website. We can use that Damodaran website beta for the valuation, which is very every half yearly they give the project beta of the each sector. So it is IT sector, auto sector. So we can use take the beta from that, or we can give take a, if it is IT company, then we can use IT companies like Infosys, Wipro, F4, TCS, 5 to 6 IT companies, and average beta. And the beta can be available from various websites like moneycontrol.com or Yahoo Finance, Skinner.in. There are various websites available there which gives the beta information. Then market risk we have to calculate. So market return, first we have to calculate. Market return is nothing but the BSE Sensex return, means we take normally 20 years return, like a much is giving right now. Market return less risk-free rate, we get the market risk premium. And once we get the cost of equity, we apply this cost of equity into weight of equity and a weight of debt. Like if we are having 60% equity and 40% debt, based on that we calculate the weighted average cost of capital. Then since we get the enterprise value, from enterprise value we have to deduct debt, minority interest, market value of preference shares, plus add back cash and cash equivalent. so that we get the equity value. Since we give the valuation equity per share, so we have to know the equity value of the company. So equity value, once we get the equity value, we divide by the number of shares, we get the price per share. So in valuation report, we give the value per share. Then there is a market multiple method. So in case of market multiple method, we use normally two types of multiples, like equity multiples or enterprise multiples. So in case of equity multiples, this is PE multiple, price to sales ratio. We use enterprise values, EV upon revenue, EV upon EBITDA. So it is very easy form of doing the valuation based. We have to just find out the multiples and do the valuations. It is a relative form of valuation, but properly comparable should be proper. Otherwise, our valuation will go wrong. Suppose this is an example. So ABC company, if we do the valuation of ABC company, we expect the next year forecast would be 1.5 EPS. And we have the comparable companies XYZ corporations. And XYZ companies forecast EPS is 0.8. And current share price is 20. Then PE is 25. So if we want to value ABC company, we can use this information, PE multiple 25. So 25 multiplied by 1.5, we get the price of ABC company shares, 37.5. Also, we can do the multiples, find out the multiples and take the averages. Like if we go for the beverage company, so we can go for the Coca-Cola company, PepsiCo company. So all this information can be easily available from the websites. We can go take the financials from the websites. We can get the valuation like EV upon sales, EV upon beta. Then we can obviously do the averages and do the valuation of our startup. Then there is a first Chicago method. This is also extended form of DCF method to do the valuation. But in this, we expect that there would be three scenarios for the valuation, like worst case scenario, normal case scenario, best case scenario. Valuation is done for each of these situation and finally with the probability. So like this, we expect that the valuation of the company is a base case. Means if the as per our projection, if the business is doing good, then valuation would be 120 million. And if we expect that there would be much growth in the business, then the valuation would be 180. If business doesn't do as per our expectations, then the valuation would be 50 billion. And based on these cases, we give the probabilities. So valuation into probability, we get the average valuation of the business. Then we have the venture capital method. This is normally is followed when doing the investments. So in case of a venture capital method, there are the two terms, post money and pre money valuations. So in case of post money, this is a case study. So pre-money and post-money differ in timing of valuation. So pre-money means without taking any latest funding in the valuation. And post-money means including the latest funding capital injection. So if we take the example, like Panel Venture PE startup company want to invest 4,000 million and they expect a 40% return. And a similar type of business is having a EBITDA of 5,000 million for 5 years, and EBITDA multiple is a 6 for 5 years. It is given. And best system is likely to have a debt of rupees 2,000 billion and cash balance of 600 billion. So what ownership share should they ask? What is the post-money valuation and pre-money valuation of the startup? So required rate of return they are asking is 40%, and their period of holding the investment in the company is 5 years. And they are investing 4,000. So an EBITDA of this company is 5,000, similar, and multiple is 6. So enterprise value, if we multiply 5,000 into 6, 30,000. So 30,000 is the enterprise value. We should have the equity value. So we add back cash and cash equivalent 600 and deduct 2,000 as a debt. So we get an equity value 28,600. But this 28,600 is 5 years afterwards. So we have to discount this and get the present value. So when we discount this by required rate of return, this is 40% into number of years. Then we get the valuation as a 5317. So 5317 is post money valuation, means including a 4,000 million in the business. And if we deduct this 4,000, then we get the pre-money valuation. Even we can take one more example. Young ET Limited company is expected to go live on public, means they are going for the IPO after 10 years, and they are expecting that revenue would be 95 crores. And the PE multiple of similar ad tech company is a 20, and they are expecting 45% return. So exit value would be nothing but 95 crores into 20, 1,900 crores, and the value of the company would be nothing but 900 crores. If we want 45% return, you have to discount this 45% raised to number of years, 10 years. Then we get the 46. This is the value of business currently. Then there is a Burkus method. In this Burkus method, we assign the range of values. Instead of giving one value, we assign the range of values. But Burkus method is not followed usually in India. So in this, we assign range of values based on these 5 factors: sound idea, prototype, quality management team, strategic relationship, product rollout or sales. So all these 5 elements are taken care while valuation. Then there is a scorecard valuation method. This is all for the pre-revenue business, so which are not having any revenue generations. So in Burkus, there are 5 5 criteria, but in case of a scorecard, there are 7 parameters like management team, size of opportunity, product technology, competitive environment, marketing, sales, need for additional investments. So all these are factors considered for doing the valuation. And the last method is risk factor submission method. In this method, we take instead of 7 or 5, we take 12 elements to value the business. It can be management, stage of business, whether it is a early stage or a mature stage, funding, capital risk, manufacturing risk, technology risk. Since if the startup is having an international presence, and then there are international risks are also associated with them, sales and marketing risks. So all these risks are taken care while doing the valuation of the business. So with this, I end up this my presentation. I hope I have properly done my work and done my presentation well, and pass on the information to all the participants.
Thank you, Nirmala ma'am, for your words of wisdom. It was really an enlightening session. Here,
Thank you.
I would like to add that we have over 400 registrations for today's webinar, and that's really a huge number.
Thank
Now, I
you.
believe we are over with the session, so we can conveniently conclude the meeting. So I thank the eminent speakers, CA Hardik sir and CA Nirmala ma'am, for for deliberating us on the upcoming avenues. And thank you all the members for giving us a patient hearing. With this, I see Akansha Gupta sign off. Thank you.
Thank you. Once again, thank you, ICAI, and thank you, Gyan sir, for giving me this opportunity. Purushottam